Hello and welcome to SkyBridge Views. I'm Anthony Scaramucci. I'm the founder and co-managing partner of SkyBridge Capital.
And I'm Ray Nolte, Chief Investment Officer and co-managing partner here at SkyBridge.
As Ray knows, SkyBridge Views is a place for us to have an open conversation about our business, the marketplace, and the economy. And because this is super informal, anything can happen here. It's not live TV. I want to start off, Ray, I want to talk about the Brexit. What's your opinion of the Brexit? What do you feel is going on there?
Good. I think the Brexit really hit a chord that's going on in the UK right now. It's around independence, sovereignty, people taking control of their government once again. And so I think that was more of what it was about.
But you as an analyst, you analyze the issues around the Brexit. A lot of people, frankly, don't understand it. So what was your take? Were you recommending the UK stay in or stay out, or what was your view of it?
Look, I think overall it would be more stable if they stayed in. I think there was probably a solution set where they could work out the differences, because I don't think it had to do with economics, and I don't think it had to do with core mission. The core mission, if you go back when it was put together, was about commerce and trade across the European Union. And over the time that it's been in place, it's morphed into something completely different.
So why do you think 52% of the voters in the UK voted to leave the EU? Why isn't it working for them?
Look, I think there's probably 52% obviously voted. I'm not sure that 52% knew what they were voting for. There's probably a hardcore constituency that wanted out. There's a hardcore constituency that wanted to stay in. There's that middle swing, and that could go a couple percent either way, and they happen to catch them on the day where they want out.
So Ray, is out? Do you actually think that these guys are done, or do you think there could be a potential another referendum coming?
I think the probability of another referendum is fairly low.
Why?
I think because I think you can't have a vote and then say, oops, only kidding. Though you could draw an analogy that we did that here with TARP. 8 years ago at the start of the crisis, you saw the violent outcome in markets, and it was like, oops, we made a mistake, and you went back. So it could happen. I suspect here what you're more likely to see is some type of compromise deal come out, especially now that you have these other countries like France coming out and talking about their own referendum.
Do you like the UK economy here?
I think the UK economy is going to lose probably, half a GDP point or so from this. I don't think it's going to be as bad as some of the pundits say, but I also don't see any significant upside from here.
So what is your view of the U.S. economy here, the impact of the Brexit, and where do you think the U.S. economy stands over the next 12 to 18 months?
Well, over the next 12 to 18 months, I think we continue to bounce along the bottom. I think the economy that we've experienced really post-crisis, nothing significant is going to change in that. We could get a little movement come the U.S. election as we move into the end of the year, depending on what the outcome of that is. But I think fundamentally the U.S. economy is sound. We're going to continue to plug along at 2% growth. I don't see anything that will really cause that to accelerate. The Brexit and situations in Europe, I think, really just result in maybe a tenth of a point of GDP loss.
For the U.S., more significant for the U.K.
Absolutely.
What's your thoughts about the hedge fund industry, the condition of the hedge fund businesses, if you will, during this period of time?
Yeah, well, I agree completely that we're going to continue to see heightened volatility throughout the balance of this year.
Isn't that good for hedge funds?
And it should be good for hedge funds. What tends to get hedge funds are certain transition periods. So as I look at it and go back in time, roughly every 5 years you hit a difficult patch for hedge funds. 94 was a difficult period. 98 was a difficult period. 02, 03 was difficult. Obviously 08. 2011, and I know it's hard to believe, but here we are 2016, roughly 5 years later. You go through these 6 to 9 month downturns.
Do you think we're emerging out of a downturn now?
I do think we're emerging out of that downturn.
So the media bashing is undeserved?
No, it was deserved for the performance that you saw from last summer through
the
beginning of Q1.
The proclamation by the media that the industry is dead, and I guess 5 years from now there'll be no hedge funds and that sort of nonsense. You don't believe that?
It's been declared dead half a dozen times before.
Right. And yet the assets keep going up.
They keep going up. And, in fact, I think this Brexit situation is very telling. We went back and we looked at the performance data coming in Friday from all the managers we're invested with, and they held up extremely well.
So a lot of these managers were very well prepared, right? It was sort of like, if it goes in the way of remaining, you may get a tiny bit more upside, but not too much. But boy, if we get this thing wrong, and the expectations right now are that they're going to remain, you're going to see the sort of volatility that we saw.
Absolutely, and there were some very interesting hedge positions that managers could put on going into it, and many of them did. So you look at a transaction like LSE and the Deutsche Börse deal. That deal was slated to close. It had a 4% premium in it, was fairly tight. So if you bet that deal wasn't going to close, at worst it could cost you 4%. And if the deal broke, you could make a lot of money. So people were putting on that deal in reverse as a hedge.
Right.
People were buying bunds and shorting into Italy and Spain, thinking that those yield curves could really blow apart. So there were a lot that managers were taking advantage of.
So I mean, I think this is a good point for people that are listening and watching right now, that the industry sort of has this ambidexterity of skill sets. It can go up and down the capital stack. It can go long. It can go short. It can play country indexes, industry indexes, currency hedges. There's a whole multitude of things that people can do. And so when you have circumstances that are beyond all of our control, there's still tools in place that can help dampen down the volatility of your portfolio and help increase your actuarial return.
Yeah.
Is that fair to say?
Absolutely, and that's really what hedge funds are about. They have a larger toolbox. They have a larger set of things they can utilize in building their portfolios out.
So we made some changes to the portfolio. It's the $3 billion of movement in capital, shifting back into structured credit. Where do you think SkyBridge is going as it relates to the portfolio over the next 6 months?
Yeah, well, I think the vast majority of the changes we made were in the fourth quarter and the first quarter. We turned over about 45% of the portfolio. We repositioned it, and I think we repositioned it for a more volatile environment.
Was that, in hindsight, now that we're halfway through the year, was that a smart thing to do?
Well, certainly from the performance the last couple of months in this volatility, it was. It's always hard looking back and saying, what was the drivers? I think the primary drivers then was the event-driven space that we were in was transitioning. It was not performing as we would have expected. Sitting and hoping it gets better is not a strategy. We came in, we looked at better opportunities elsewhere. We made those shifts, and those shifts were also made looking for heightened volatility for the balance of the year.
So I think it's important to state this then for investors out there that are investors of ours. We're not waiting around for things.
No.
This has been a very proactive strategy, and we're going to continue to be proactive. And as markets change, we're going to be changing with the markets.
Yeah, and one example of that is as we were making those shifts in Q1, we noticed in the back half of that quarter going into March, volatility came down sharply. You had the VIX come down to 22 to 13.
Right.
We said that's a great entry point to get long some volatility. So we put about 6% of the portfolio out into long vol strategies, which are the ones that are helping us make money now.
So that's obviously worked. Let's switch gears and talk about the high net worth individual, somebody that would have a few $1 million in their portfolio, and they came to you for advice. What would you say to them?
Look, I think if you look at a typical 60-40, 70-30 split, you can go in and do the math. Do I think a 6 or 7% return from equities over the intermediate to longer term is reasonable? I think given where the economy is, that's a reasonable assumption. So let's say that hits your target. And this also goes for institutions who are looking at this issue. On the fixed income side, however, the 10-year Treasury is trading at 175. Intermediate to long term, I know what I'm going to get holding that. I'm going to get 175. How do you make the math work? 175 and 7? You don't get to an average of 7 with any mix there. So what we're seeing the institutions do, and I think this tracks through to the individual that you just described, is if you look at a basket of hedge fund strategies, it's a reasonable expectation that you could get a 6 or a 7% return out of those with fairly low correlation or different movements than you're getting in your stock and bond portfolio.
So I think this is important to really emphasize for people that a lot of actuary people, chief investment officers at different firms are looking at total returns and saying, wait a minute, there is a role here for hedge funds. Yet the hedge fund industry has underperformed the stock market. It has given a general appearance of poor performance recently. How would you explain that to somebody that you wanted to consider hedge fund investing for 2016, where we are today and beyond?
Look, I would put it, again, back in context. If you look over the last 5, 6, 7, 8 years, hedge funds have returned roughly what equities have returned. They've done it with about a third of the volatility of equities.
Right.
This past year or so has been a difficult period for hedge funds. But like we mentioned earlier in our conversation, every roughly 5 years you have a difficult period, then they stabilize and they do better again.
So it's super important then to condition people to think long term. I often say that people are long term investors until they have short term losses, and then once they have the short term losses, they totally want to rearrange their asset allocation and their management style. And what we know is that's the absolute wrong thing to do. And it's always being done at the wrong time.
It's always at the wrong time. Now, the other thing that I think is important to let people know and understand, the era of a decade ago where hedge fund returns were 10, 15, 20%, I don't think we're in that era anymore.
Right.
I think those are gone.
So that's an issue because industry fees are very high. And let me be a hedge fund critic for a second. If we're in a low total return environment, what is the justification for paying 1.5 in 20 or 1.25 in 15 or whatever these fees are, which let's say I'm going to earn a 7 or 8% return, the hedge fund manager could be taking 1 or 2 of that for themselves. Does that seem fair?
Yeah, I think the fees that were charged years ago were probably indicative in a market that was less well known, less well understood. I think you've got greater efficiencies now, more capital in now, and you've seen pressure on fees. I think that will continue, and I think the era of 2 and 20 is no longer going to be the standard era, and I think that's going to come down. And one of the things we at SkyBridge have been able to do is aggressively drive down fees with the managers we're dealing with.
So if you want to have hedge funds in your portfolio and you are a high net worth individual or a small institution, one of the benefits of being with SkyBridge is that you can come to us. We do the qualitative and qualitative assessment of the portfolio, the individual managers in the portfolio, and then because of our size and scale, we can get to those managers at a lower price than if you went direct to those managers. Even if you build in all of the fees, including the fee that you're charging
we
SkyBridge.
use our buying power to drive down the prices, and then we return all of that back to our investors.
So you're getting high quality managers that are willing to take fee breaks, right?
Absolutely.
We're focused super amounts of time right now on Great Britain and Europe, but there's also a slowdown going on in China right now. How much risk is China to the global economy and to the overall investment portfolio at SkyBridge?
Good. To our portfolio right now, it's not a significant risk. We have basically no Chinese exposure. We have a small short in the Chinese currency, but it's not a really meaningful position today.
Is this because you're bearish on China, or our management team, investment management team is bearish on China? Or is this because you're just, not focus on that area, that sector of the world? What is the reason?
I think at this juncture, China's going through a transition. I think the Chinese government will manage that transition the way they want it managed, and I think trying to guess and maneuver around the Chinese plan is a very difficult thing to do. So our view is it's best to stay away. Now, given the strength of the dollar and the peg that the Chinese currency has to the dollar, there's some sense that they need to devalue their currency a bit. So in case that happens, we put on a little bit of risk there while we had longer beta in the portfolio. As we were transitioning the portfolio in Q4 and Q1, and we got out of a lot of that beta, we took some of that hedge off because we didn't think it was really needed.
And you've also got the exacerbating factor of the pound being devalued and other currencies relative to the dollar being devalued. That strengthens the dollar on the global stage and forces more potential devaluation from China, which will slow down their growth, slow down the quality of life inside of China, and blow through a lot of their currency reserves.
Yeah, I mean, that's where the world's all interconnected. So, you do get a shift. You need to be aware of that shift. And it's an order of magnitude of how big is it going to be. But I go back to China, and they control a lot of things that the other Western economies can't control because of the nature of their system. And so I think it'll be more orderly than people think.
Travel all over the place on behalf of SkyBridge and make a lot of presentations that different FA meetings, lunches, dinners. There's a thematic question that comes up often. It's usually from high net worth individuals that raise their hand and they're looking for the holy grail. They're looking for the magic tonic, Ray, where somebody has all the answers. It's very easy to second and triple guess people when markets are volatile and people throw their hands up and say, geez, FAs or hedge fund managers really don't know what they're doing and this sort of stuff. And people are looking for that perfect scenario. What is your response when you hear those sort of noises in the system?
I mean, I think I just get back to reality. There is no magic, tonic. There is no magic potion. It gets back to the point you made. You need a long-term strategic plan, and then you need to sit with it. And so you need to build a portfolio that will let you ride through these various waves and storms. Should someone have gotten out of all of their bonds when everyone was screaming, bond prices can only go down, yields up? Well, what have we done? We've continued, another couple of years of, bonds rallying. So this is all about asset allocation again.
The big theme is you're going to get a lot of things wrong in the short term. If you start to guess and gyrate with the markets or get your mood tied to the short term things that are going on in the markets, you're going to get a lot of things wrong. But if you stick with a steady, consistent long-term plan, and one piece of that plan, one slice of the pizza is in hedge funds, the chances are you're going to get to your goals with a lot less volatility and more safety, and you'll feel better about the experience.
Yes, you tilt on the margins off of those allocations, but you set up a general steady state, you stick with it, and you move forward. And again, when you talk to investors and they want to compare hedge funds to stocks, you're not buying hedge funds to replace your stocks, you're buying them to help the entirety of the portfolio.
I want to ask you about your feeling of how you would explain negative interest rates to people, because people are reading about negative rates in Europe and other places, and they see very low rates in the United States. What are the implications of negative interest rates?
Look, I think negative rates are actually pretty bad for economies overall. I think you need to get a return on your capital. I think it's been largely fear and risk of loss of capital that have driven people to this negative rate environment. I don't think it's sustainable over time, and I think it's very damaging over time.
So what would you do to our portfolio to adjust things to this sort of environment?
Again, I think you stay. I think you need to stay in strategies where you can actually generate better cash flows than the cash flows associated with the risk-free assets without taking undue risk. And again, we look at some of the structured credit markets, we look at some of the mortgage markets, we look at some of the CLO and the loan markets, and think that you can find good, sound investments there that pay, in some cases, hundreds of basis points more than risk-free rates. Because I do think part of that driver is the banking system moving and the way the regulators apply capital charges to different instruments, which make it hard for banks to hold these other assets. Likewise, on the mortgage side, you may have a base rate that's tied to a treasury function, but there's still a decision to make a loan to a person secured by a house. And those rates have shown that they're very sticky when you get down to these levels, and they're not coming down and trading at as narrow a spread as they've historically have.
Are you thinking that the market will be more stable over the next 18 months or less stable?
I think it depends on what time frame you look back at. And I think it's very, so bottom line is I think it will be quite volatile, not stable, when you look at it day to day and week to week. But when I think you look at it from point to point, it'll seem more stable than it is. And so Q1 is a great example of that.
That augurs for longer horizons for investors, because as you're pointing out in Q1, we were down 11, 12% in the first 6 weeks. We then got information from the Fed saying that they weren't going to continue on their path of raising rates, and the market snapped back. And so if you went away for 90 days, the market looked roughly unchanged, and yet
you're up 1% and change.
The election is coming up, and there's a lot of concern about the election. And so what are your thoughts about the election coming up in the United States?
Look, I think the election is going to continue to keep heightened levels of volatility, heightened levels of uncertainty. I think people just have to live through that. manage through that, which gets back to set your allocation up appropriately and ride through these waves of uncertainty.
So on Wall Street Week, there's been a number of our guests, whether it's a Jeffrey Gunlock or it could have been a Mark Lazary, all have roughly the same opinion. Jerry Kaminsky, that the election is going to have very little long-term consequences to your overall portfolio. Do you believe that?
Yeah, I do.
I want to thank my partner, Ray Nolte, for joining us today on SkyBridge Views. Until next time, be prosperous and healthy. Thank you.
All investments are subject to risk, including the possible loss of the money you invest. For more information about SkyBridge Capital Multi-Advisor Hedge Fund Portfolio Series G, call 1-888-759-2730 to obtain a prospectus. Investment objectives, risks, charges, expenses, and other important information about a fund are contained in the prospectus. Read and consider it carefully before investing. This webcast is for educational purposes only. We recommend that you consult a professional advisor about your individual situation.